So we're in Greensboro, North Carolina today. We're in the Midtown area and we're closing this 66 unit apartment complex. So as you know, we drove up from Florida and we got hit with a winter storm. The trees have all had, frosting on them and everything. We're all bundled up, not used to this cold weather, but it's still exciting. My fingers are a little numb out of excitement and also the cold, and we're gonna go walk around this. It is 100% occupied right now, so we can't see inside of any of the units, but we'll do a walk around and get a feel of the property and the asset. So this is a value add project, meaning we're gonna put some capital expenditures into the property to get a return on our investment. So one of the very few exterior upgrades we're gonna make is painting the exterior windows here. We're gonna give this the silver. We're gonna give that a black finish coat. And what that's gonna do is just give it a more modern look, make it look a little bit better on the outside so that we can attract the good area or the good tenants that this area has, the white collar tenants, high income wage earners, things like that. So that'll give it a nice little facelift on the outside. So another value add project we're gonna do is for this covered parking right here that's currently no extra charge, and that's kind of like a premium feature with this property because as you can see there's entry doors along here. You kind of pull in right to your units. So this is a feature that we can charge a little bit extra for, whether it's $15, $20 a month. That'll directly add to the NOI by charging for that. So this covered parking will be a little value boost for us as well. All right, so our friend the sun just came out, which is warming us up a little bit. But back on the value add process, so 15 units currently out of the 66 are outdated. So what we're gonna do, because it's 100% occupied, as those turn or take the month-to-month tenants, and as they move out, upgrade those units, and we're gonna put granite countertops, LVP flooring. So that's gonna give it a fresh new look, obviously a coat of paint, give it a fresh new look, match the condition of the other units and match the condition of this area because it's a better area. So get those upgrades in and then re-rent those at the market rental rate. So currently over all 66 units, over the average, they're $130 per unit under market. So over our value add process, we're gonna get those up to market rents, increase rents by $130 over a per unit average. And that's gonna add, big time to our NOI by adding over $100 of rent bumps over this 3 to 5 year span. So good value add project here. And what I like about that is it's a more digestible process. It's not some big value add project where we're rebuilding a burnt down property or anything like that. It's pretty light cosmetic renovations we're adding. So lower risk on our end for the first syndication for us as a group. It's a smaller project that we can easily manage and give a good return to our investors. Nicole and I took the trip up here to close this thing. We're hoping to close on Monday, and it's now Friday, and it's gotten pushed back to early next week now. I think it's gonna close on Monday, and that's no fault of our own. It's just really the lending process. It's a government-backed loan, so it goes through a lot of checks and balances. Things change, they gotta resend it to the underwriter, check off again, so now we're gonna close on Monday. That's another reason why we didn't want to go inside to disturb the current property manager or the staff on site before we actually close. Don't want to give this thing another hiccup. But wanted to talk about that is the lending in this and how we structured the deal. So we got 80% loan to cost on this deal, meaning that the total project cost with CapEx and everything, we financed 80% of that with a Freddie Mac small balance loan. And what that is a government-backed mortgage by Freddie Mac, the government lender. And we got an interest rate at 3.76% for 25-year term, and it's fixed over that term. So it's got really good favorable financing, low rate for us, and it's gonna increase our cash flow and also allowed us to bring a smaller amount because we got loan to cost, which obviously gives us higher returns on the back end. We're still at a good leverage point because the value of this asset is gonna go up over time because it's not being ran very efficiently. And just for example, they have the current operators have a $50,000 per year cable contract that's not even really being utilized by the residents. So by eliminating and canceling that contract, we're adding $50,000 to our NOI immediately, which you think about the market cap rate, I think it's sub 6 is going to add big time value to this just by that, not even including the renovations and the CapEx we're putting in to get the rents up. So I mentioned it was a loan to cost loan, 80% of that. So meaning we brought 20% down to close the deal. So how we did that is we syndicated this, meaning we raised outside capital. It was a 506B syndication, B for buddy, friends and family, stuff like that. It was mostly sophisticated investors, which I like because out of my personal network, it just helped to get people into this deal that maybe weren't accredited yet, but had the capital to invest in something like this. So we took the investment minimum of $50,000 to get into this deal. I think we have 17 total investors, and we raised $1.75 million total. And out of that, my role was to bring capital to the deal. So my partners, Michael and Scott, they're in the Carolinas, kind of like, Michael Scott from The Office, but two different guys, Michael and Scott. They found the deal. And then through a mutual connection, my friend Jake Volan brought me into the deal, and my role is to raise capital. So I brought about $400K to get into this. So almost a fourth of the total raise. And that was just out of, personal connections, networking, meeting people, sharing my passion for real estate, and now bringing some really awesome people into this deal that are going to get the benefits of, the appreciation, the depreciation, obviously the cash flow, the equity growth over time. So all of this, they get to partake in because they own a chunk of the property now. So super excited to have them in, super excited for this to be my first syndication, to be a really strong deal in a really strong market like this. So that's how we structured it, raised the money, and put the deal together. So the overall strategy with this property is a 5-year hold, light value add, and over time, over really the stabilization period for 2 to 3 years, will be to renovate the units, implement, cut that cable contract like I was talking about. There's also storage on the bottom level that there's 12 units, we're gonna double that because there's a space for it. I think those bring in another $40 a month. And that's one thing that in due diligence, we found out that's what the tenants want. So that'll be a cheap way to add to the top line revenue. So the strategy is to add value over those years, hold it for 5 years. In the 5-year point, we'll have take this $6.2 million asset up to around $8 million plus, and we will then sell it, give our investors, through that hold period, they'll earn their initial capital back just in cash flow, and then get a big equity kicker on the back end at sale. So really like that. And then just going forward, we really like this market a lot. So through due diligence, we learned a ton about the specific area, about Greensboro and the Tri-Point areas as a whole. So already looking for that next asset because we're comfortable with this market, especially this sub-market in this location. So hopefully roll this progress and take this closing into getting the next one under contract and keep the ball rolling. So if it's something you're interested in, if you want to learn how to invest in apartments like this, let me know, send me a message, and we can have that conversation. But thanks for watching.